Hey everyone, welcome back to ZT Financial TV. Today we're diving into a critical topic. Gold prices are skyrocketing, and there's a big reason why. This isn't just about inflation. What's happening right now is a global financial shift that could impact your wealth if you're not paying attention. If you want to protect your wealth, please listen to this video. Please like and subscribe so you can rewatch later if needed. Now let's break down the main reasons behind gold's surge. The first reason is the U.S. national debt and the shift from U.S. bonds to gold. As of February 2025, the United States' gross national debt has reached $36 trillion, surpassing the nation's economic output for over a decade. In fiscal year 2024 alone, the federal government reported a deficit of $1.8 trillion, an increase of $138 billion from the previous year. This escalating debt has raised concerns among international investors about the long-term sustainability of U.S. fiscal policies. Consequently, many countries are re-evaluating their investment strategies, leading to a notable shift from U.S. Treasury bonds to gold. In 2024, central banks worldwide added a total of 1,045 metric tons of gold to their reserves, marking the third consecutive year that purchases have exceeded 1,000 metric tons. This trend shows a strategic move by nations to diversify their reserves and reduce reliance on the U.S. dollar. Poland's central bank was one of the biggest buyers, acquiring 90 metric tons of gold in 2024. China increased its gold reserves by 29 metric tons, making it the third largest gold buyer after Turkey and India. This consistent accumulation of gold reflects a global effort to strengthen financial resilience amid economic uncertainty and geopolitical risks. The move away from U.S. bonds toward gold suggests that countries are trying to protect their economies from potential U.S. economic downturns. Gold, traditionally seen as a safe haven asset, acts as a hedge against currency devaluation and economic instability. This trend also signals concerns about the de-dollarization of global reserves, as countries look to reduce dependence on the U.S. dollar. As of 2024, gold now accounts for approximately 15% of global reserves, a significant shift in reserve composition. Now let's talk about the second cause, U.S. gold reserves and the call for a revaluation audit for Knox. To restore confidence in U.S. Treasury bonds, Elon Musk, leading the Department of Government Efficiency, DOGE, has proposed an audit of the U.S. gold reserves. This initiative, supported by Senator Rand Paul, aims to increase transparency regarding the nation's 8,133 metric tons of gold, the largest national reserve in the world. However, this gold is still officially valued at $42 per ounce, a price set in 1973. At current market prices, $2,900 per ounce, the true value of U.S. gold reserves is over $750 billion, far more than the outdated official valuation. If the U.S. officially revalues its gold holdings, it could restore investor trust in U.S. bonds and boost confidence in the U.S. economy. The third reason is, will the Fed decrease interest rates and print money soon? Let's look at U.S. neighbor Canada's interest and money printing policies. Historically, the Federal Reserve often observes Canada's monetary policy adjustments and may follow suit after a few months. This pattern allows the U.S. to assess the impacts of such changes on a smaller scale before implementing them in its larger economy. For instance, in 2024, the Bank of Canada initiated rate cuts in June, followed by the Federal Reserve beginning its rate reductions in September of the same year. This approach helps mitigate risks associated with being the first to adjust rates, which could have significant implications for both the U.S. and global economies. Currently, the Federal Reserve has paused further rate cuts, maintaining the federal funds rate between 4.25% and 4.5% as of January 29, 2025, due to persistent inflation concerns. However, if inflationary pressures ease, the Fed may consider following Canada's lead in reducing rates to stimulate economic growth. Understanding this dynamic is crucial, as shifts in monetary policy, especially by major economies like the U.S., can significantly impact global financial markets, including gold prices. Let's look back in 2020 COVID-19 crisis. The Fed followed Canada. On March 4, 2020, the Bank of Canada cut rates by 50 basis points to 1.25%. Then on March 16, 2020, the Bank of Canada cut rates again to 0.75%. Shortly after, on March 15, 2020, the U.S. Federal Reserve responded by slashing rates to 0 to 0.25%. Another example is the 2008 financial crisis, the same pattern. On December 2007, the Bank of Canada cut rates from 4.50% to 4.25%. Following Canada, on January 2008, the Fed cut rates sharply from 4.25% to 3.50%. And now, in 2025, Canada has already started cutting rates again. If the pattern holds, do you think the Fed will likely follow within months, which means more money printing and rising gold prices? Whenever the Federal Reserve prints money and lowers interest rates, gold has historically surged. Let's look at the data. In the 2008 financial crisis, gold surged 166%. In September 2008, the Fed slashed interest rates from 5.25% to 0.25%. Massive money printing followed with quantitative easing. Gold prices jumped from $700 in late 2008 to over $1,865 per ounce by 2011, a 166% increase in just 3 years. During the 2020 COVID-19 pandemic, gold surged 38% in 1 year. In March 2020, the Fed cut interest rates from 1.5% to 0% and printed over $3.5 trillion in stimulus. Gold surged from $1,500 in early 2020 to a record high of $2,058 per ounce in August 2020, a 38% gain in just months. Imagine if you had invested $10,000 in gold before 2008 or 2020. You wouldn't just have protected your money, you would have nearly tripled your investment. So, what does this mean for 2025? If the Fed cuts rates and starts printing money again, just like in 2008 and 2020, gold prices could break new records, possibly exceeding $3,000 per ounce. Investors who hold gold will not only protect their money from inflation, but actually profit from the price increase. This is why gold is one of the best hedges against inflation and economic crises. The fourth reason for gold's rise is tariffs and gold movement. There's growing speculation that Trump may impose tariffs on gold imports. Just like the 25% tariffs on steel and aluminum, a gold tariff could make imported gold more expensive. This has already triggered a rush to buy gold before tariffs take effect. The announcement of these tariffs has led to significant movements in the global gold market. Fearing potential tariffs on precious metals, traders and financial institutions have accelerated the transfer of gold reserves to the United States. Approximately 8,000 gold bars have been withdrawn from the Bank of England's vaults in recent months, representing about 2% of its total holdings. This surge in transfers has increased the waiting time for gold withdrawals from a few days to a minimum of 4 weeks. The relocation of gold is primarily driven by concerns over potential U.S. tariffs on precious metals and the widening price gap between gold in London and New York. Gold futures in New York have risen 11% this year, closing at $2,935 per troy ounce on February 13, 2025. Analysts predict that prices could soon reach a record high of $3,000 per troy ounce. This strategic movement of gold and the implementation of tariffs are indicative of a broader financial maneuvering, often referred to as a new currency war. Nations are adjusting their economic policies, including currency valuation and gold reserves, to navigate the evolving global trade landscape. And the final reason for the surge in gold prices is gold is legal currency in U.S. states. Do you know that 11 U.S. states are already recognizing gold as legal tender? Utah, Louisiana, Oklahoma, Missouri, Arkansas, and Texas have all made gold and silver official currency. West Virginia has removed taxation on gold. Florida is actively studying the idea of gold-backed payments. Is this a sign that the U.S. dollar is losing purchasing power? Could the U.S. government be preparing its citizens for a period of significant inflation that will further erode the dollar's value? Backing the currency with gold could be a potential solution to restore confidence and prevent financial losses. Encouraging citizens to hold gold may also help mitigate the economic impact of a weakening dollar. The question is, how to protect and grow your wealth in 2025? With all of this happening, how do you stay ahead and protect your financial future? First, invest in physical gold. Owning physical gold bars and coins ensures you hold real value, not just paper currency. Consider gold dealers that provide secure storage options. Second, invest in gold ETFs. If you prefer a more liquid option, ETFs like GLD allow you to track gold prices without handling physical gold. Third, watch the Federal Reserve's next moves. If the Fed follows Canada's lead and starts cutting rates, gold prices will likely skyrocket even further. Finally, consider other safe haven assets. Precious metals like silver and platinum also tend to perform well during economic uncertainty. Real estate and certain commodities can also be strong hedges. Gold has always been the best protection against inflation and economic uncertainty. If the Fed cuts rates and prints money in 2025, gold could surge past $3,000 per ounce. The US government might be preparing for a financial shift by accumulating gold. Several US states are already treating gold as currency. Could this signal a return to a gold-backed system? What do you think? Drop your thoughts in the comments. Like this video so you can find it later. Subscribe for more financial updates. Thank you for watching.